Hello, everybody. Welcome to Blockbytes. It's me, Corval, with you today. Got a new lending strategy for you on the BNB chain that I want to show you. It's for segment finance. Now, if you've been following the channel, you know we partnered with them a few weeks ago before their LGE. Their site is now live, and I'm here to show you how to use it and what I'm going to use it for. So let's get started. Quick refresh on segment finance if you don't remember. One thing I should mention, we did a video on them previously, so be sure to check that out. It'll answer all your questions, hopefully. But in summary, segment finance is a lending market on BNB. It's a fork of Sone, which means they have this innovative VE tokenomics system. So the reason why it's valuable to accrue this SEF is because of this protocol revenue distribution they've got going on. Lots of projects promise to share revenue. But the thing that's really interesting about SEFs is you are getting money from like the protocol usage, like liquidation, the fees on liquidations, the fees on loans, all that sort of thing. But you're also getting the Athena rewards that they're getting from their VE NFT and their incentivization of those of the liquidity pool on Athena, where they have SEF paired with USDT. So that's two revenue streams coming to you for a really low cost, just from using their project. If you want to know more about that, if you want to learn how that actually works, check out my other video on segment, or I kind of talk about it a little bit more. Let's check out their dashboard right now. Just to give you an idea what we're working with. Anyway, here's the dashboard. All they have live right now are their core pools, which is just fine by me. The key point of interest here is look at all these juicy supply APRs, right? Fat, and not a single one under 20%. And I've never even seen this before, but their borrow APRs are negative, which means that you're not even paying net interest on the loan. Now, that's obviously not sustainable. Right now, because this project is so new, they're heavily incentivizing usage. So that's why you're seeing these APRs even in the negatives and why they're so high. So if you come over to this page, I believe, the SEF page. Now, SEF is their tokens, the segment finance token. And you can see here how they're using it to incentivize their pools. 21.5% of the APR for USDC is coming from SEF being distributed as an incentive. We come back over here. That means that only like 2.5% is coming from interest being paid. We go back, the borrow side, 10%. You're getting paid 10% on your loan. Like when you take out a loan, they pay you 10%. How that's happening is they're just giving you a bunch of SEF for it. So in summary, these are bloated numbers at right now. They're inflated because of the SEF distribution. Now they're doing this to try and get users, trying to incentivize use early, and they're also trying to get their SEF out there, because how the SEF token works is you stake it in a vault, one of these vaults, and you get paid through the protocol revenue that's generated. So what they're trying to do is they're trying to convert early users into essentially vested interest. And I think that's an interesting way to go about it. And I'm totally going to take advantage of it. So what my strategy is here is because the APRs are so high, and you're even getting paid on the borrow side, I'm just going to loop a loan, like to get a bunch of free SEF, right? So I happen to have like $500 worth of BNB lying around. So that's what I'm going to use, because this isn't an extremely risky play, but it is somewhat risky. It's not just sitting in a vault. It's involved in a loan. So I'm going to go ahead and supply. I'll leave like a couple. I'll leave enough for gas. Here, I'll supply some BNB. All right, so I deposited my BNB, and now I'm gonna come over here to the account page, and I can see kind of like at a glance, like my net APR, daily earnings, all that stuff, my total supply, and my total borrow. So I don't have any borrow at the moment, but I want to borrow. So I have to come over here to supply to assets, flip this to allow my BNB to be used as collateral. Now I have $324.85 worth of BNB that I can use as collateral. And I'm going to immediately just come back. I'm just going to borrow more BNB. So I can borrow 80% of my collateral All right. That's the safety margin, that 20%. So let's see, I can borrow a max of 243.64, but if there's any, well, the risk is kind of minimal since I'm not getting any interest, but I'm still not going to go to the max. I'm just going to borrow. Oh, I can't borrow 200 BNB. I'll borrow point 7. Ooh, wait. I'll borrow point 0.6 BNB. All right, cool. Here we go. And I'm just looping this bad boy because all I want is I want to get that fat SEF payout. And once I get that, I'm probably just gonna stake it because it'll be essentially free money for me. I'll just get a free share of their revenue stream just by providing this loan and borrowing against it. It's kind of a crazy. It feels like a money hack. It feels like it shouldn't be legal. So let me supply some more, dude. Let me give the rest of mine back here. Supplied again, just really greatly increasing my exposure essentially. Now this is pretty risky, like looping, because you're much more subject to liquidation. However, I'm not really expecting liquidation to be a problem because I'm not paying my loan's not accruing any interest from what I can tell, any significant amount of interest. And I'm not um borrowing an asset that's uncorrelated to the underlying. It's the same asset. I'm borrowing the same asset. So it doesn't really matter if the price of BNB goes up or down because the value of my loan will also go up and down in relation to my collateral. That makes sense, right? If I give you an apple and I borrow an apple from you and then the value of an apple goes down, like I just give you the apple back. Anyway, I'll loop it again. I'll loop it again. Why not? Nice. Okay. And then supply it one last time. Let's do a quick review here of where we are on our account page. So I'm at 72% of my borrow limit, my safe limit. Yeah, so I'm a $300.06 is my safe limit, but I've only borrowed 279. Um, I'm getting paid 14% on my borrow, getting paid 21% on my supply. Looking at daily earnings of like 41 cents. Um, But yeah, not bad, not bad. Especially considering the risk is really minimal, especially at this size. I'm not putting a lot, like a significant amount of my portfolio in here. But this would also be pretty handy if you just wanted to use a lending market because you can't really beat like 21% APR on your deposit and you're getting paid for the borrow. I would just keep an eye on this to ensure that when the incentives tap out, if the incentives become too diluted, in value or the price of SEF drops too low that you're not gonna get burned and liquidated. I'd highly recommend any kind of loan you enter, especially in crypto with these money markets, you keep a close eye on your loan. Crypto is extremely volatile. You could get liquidated very quickly. One last look here at the SCF page too. I want to point out it shows you exactly how much SCF per day you can get and how much has been distributed, which I find kind of useful. Maybe less useful, more interesting. Yeah, once I get some SCF here from this farming, I'm going to dump it right here into one of these vaults. So when I was talking about the protocol revenue being shared to SEF stakers in their vaults, I'm talking about protocol revenue from liquidations and the rewards from the SEF USDDT pair they have on Thena. Now, another advantage of these vaults is it's a 7-day staking period, unstaking period. So it's not extremely long, but you should be aware that you're going to be locked into one of these SEF vaults for at least 7 days. So vault distributions happen randomly because they're buying SEF off the market to distribute to SEF stakers. The advantage of this is increasing the volume on that trading pair. Disadvantage, which means more rewards for you, but disadvantage is it's not a linear reward curve, right? You're not getting it constantly. So you're going to be getting SEF and Thena from these vaults, these staked SEF vaults. You can then take those to Thena, vote for the SEF USDDT pair, get more SEF bribes, get more Thea emissions to the pool. So you're like bribing yourself essentially. You're bribing yourself to get more rewards for yourself. So there's a little bit of a flywheel effect here that could take place. something to keep in mind as you're constructing your own strategy for how to approach this project. Just some more information I thought might be helpful for you guys. In summary, what we did here is we came to Segment, we borrowed or we deposited an asset, we borrowed against it to take advantage of those really, really high uh, interest rates for depositors and the negative interest rates for borrowers, so that we can accrue a lot of SEF. Now, once I've hit my target for SEF, or I'm just no longer comfortable with the loan or whatever reason, I'm just gonna unwind this loan. I'm probably gonna give it like 2 weeks and see how I'm feeling then, unless something significant changes in the market. But that's just me personally. I'm just trying to give you an idea of how to approach this. Personally, I'm gonna give it 2 weeks and revisit. But once I hit my target SCF or hit that 2 week time, I'm gonna adjust my strategy accordingly. And I encourage you to do the same. Hopefully, this gave you some idea of how to use Segment, and how to kind of get your value out of it. In conclusion, there you have it, folks. Segment Finance. What do you think of this strategy? Do you have a better one? If so, I want to hear about it. Shoot me a message on Discord or on Twitter, and let's make some money, baby. I'll see you guys later.